ISRG, January earnings preview. What we're looking at with our MMTs on January 1 of 2012 is getting prepared once again for this upcoming earnings season. And we have a lot of live after hour trades and earnings on our website. The thing about it is, one of the things that the MMTs really enjoy is how to remove risk and look at the imbalance of the 460 call on IRG is totally inflated. Yes, there is a weekly chart over here on ISRG. And yes, you are extremely getting into these overbought zones. And we're right up here with a very long-term trend. And they've done well, but we feel that they're overbought. And when things get overbought, that's generally about the time you have a turn in the equity. And how many times do we know that to be true? More than we can count, because that's why we look for these great opportunities. On a weekly level, I'm at 91% overbought. That means that we have been running and rising. What a bull chart. If you ever wanted to get a good example of a bull chart, this is it right here. And this is about as good as it gets. However, you got to know when those earnings are priced in. That's the weekly analysis on the name. The thing that we're going to take a look at in the daily structure is what these calls and these puts look like. Why they're overvalued here in the call side of the market, which is a 460 call. The 460 call, which is slightly in the money, and this 460 put, it's a January expiration. And it expires after the monthly expiration, and they're going to report earnings. And once again, it's a high volatility play, but we look at where the markdown value is in the daily. This is that 460 put below the market. Now, what we're looking for is even up and out of the money on the 470 call, let's say, or the 450 put below the market, is we're going to take a look at this particular put option. And it's a January contract, and it's below the market for the earnings. We can see over here that it was marked up as high as $36.09, but we're down here on these put sides. When that call is way up here inflated, this very put at this very strike price of 450, well, we're in our zone, the SMF zone. Looking at the low was $10.20. So they've been marking these things down. So that makes the participation on capital risk very low. Very, very, very low. Something that we take very extreme pride in doing. And that's always reducing the risk. So there's the 450 put. It's deflated in price from the highs of 36.09 on 12.15. In that short period of time, we've walked these things down over $20 a contract. That's the 450 put below the market. On some of the other contracts that we're going to be looking at is we're going to be looking at a 410 put for February after the earnings. And on this daily chart, we can see that in 2011, they had a high reading. They wrote them at $15 a contract. They're down here, and we're going to monitor these things because the lows were $6.50. One of the things that we're going to be looking at is how ISRG trades starting Tuesday, but where we can buy the deflated premium even lower than the 650 level. It's never been that low, and that's on a 410 put. Now, that's like $60 below the money for February. We just wanted to throw that February in there. Another one in February that we wanted to throw in was one, and these February contracts, there isn't a lot of data on them, but the high was 1887. We're just going to watch these things moving forward, going forward, because there isn't a lot of data. Like that 430 put, it's at 1070. It's still retail. It can still be marked down. So one of the things that we're going to look at is the 460 put. Right here, like I said, we're going to be watching that one close to the strike price between now and the earnings that they report on that day. A lot can happen. They can run it back up, make another high, but that call contract that we have right here, this is that 460 call, and it's inflated. Yes, it was deflated back here on 1215. You can see that the low was 565, and that was a deflated price. You can see here what happened back on 1115. It had a great run, but when they get inflated up here, this is the kind of thing that has to happen. They must go from that inflated area down to these deflated, and we're right back up here in that inflated zone on that 460 call. And what is the upside left in that call, even if they do come out with the good earnings? Look, it's a great company. No one's saying that. We're saying that this is overvalued. All right? But we're also saying on the flip side that the 460 put option is undervalued. And that's going to be this one. That's this one here. We already talked about that. And it can get a little bit more deflated. But what we're looking for is where that good news on ISRG is going to be priced into the call market, and that they run the name in anticipation, and you're getting that really good attractive markdown levels to participate compared to where the capital was. On the flip side, this 450 put, I'm going to emphasize it between now and then. We could come down lower, but we're at the lowest levels ever, being $10.20 on 12/30, December 30th. And we were marked down from $36. So we well over $20 of risk out of there. And the great move here is people never know when to sell them when they're up here, and then this happens. And that's what we're doing when you go into an earnings season. ISRG. We will be doing this earnings play. These are the contracts going out to February and the earnings report for January 2012.